I'm going to answer some common questions about short sales and 1099s and why most people should not be afraid of receiving a 1099 and will in fact not owe any income taxes even after a short sale and debt forgiveness. Let's start with the basics. What is a short sale? Well, a short sale happens when you are upside down on your mortgage. You owe more than your property is worth. If you decide to sell, the lender is entitled to be paid in full before it will release its mortgage. But that's not going to happen in today's economic climate, isn't? Unless, of course, you bring cash to the closing table, and most of us can't do that. So, in spite of the depressed real estate values, in a short sale, the lender agrees to release the mortgage even though it will not be paid in full at closing. Well, what happens to the balance due after a short sale? And there is a balance due. If you look at this example, we have a note balance of $200,000, a sales price of $150,000, and not all of that money is going to go to the lender. Some of that money will be used at the closing table for real estate commissions and closing expenses. So let's say that the net proceeds to the lender at closing is going to be $130,000. That's credited against the $200,000 balance on the note, and $70,000 remains owing after the short sale. Even though your lender agreed to release its mortgage, you still technically owe the remaining balance on the promissory note. But as part of the short sale approval process, many lenders agree to forgive this balance due. Some lenders do not. Those few that do not think you've got a money tree growing in the backyard of the property you no longer own. Well, when is there a 1099? If the lender forgives the balance due on the debt, the IRS considers that the same as you making a profit. And how do you know if they've forgiven the balance? They will say so in the short sale approval letter. It will say, we forgive the deficiency. We waive any rights to collect the balance due, some words to that effect. If they don't forgive the balance, you'll see words like, we reserve all rights. So that's how you tell. It's in the letter itself. Okay, let's look at an example. Let's say you borrow $200,000 and you get stacks of $100 bills. And the very next day, you pay back only $100,000. The lender says, don't worry about the other $100,000. You can just keep the change. You still have $100,000 in cash and sitting in some other room, and you have a $100,000 profit. That's fairly easy to see on that transaction. But let's say, what if you borrow $200,000 and you buy a house with it, and then later you sell the house and you net $100,000, which you pay to the lender to pay down your note, and the lender says, we'll forgive the balance of the other $100,000 that you owe. To you, that just feels like you broke even or you lost your equity. To the IRS, you made a profit on the loan transaction itself, just as if you had $100,000 bills. Yes, you lost money on the real estate transaction, but you made money on the loan transaction. Unfortunately, for most people, the money they lose on the real estate transaction, in other words, on their principal residence, is not deductible as a loss, and that's where the big problem comes in. But in most short sales with debt forgiveness, you have a profit because of that debt forgiveness. And the IRS expects people to pay taxes on profits. To keep people honest, the IRS also requires companies to tattle on you. That's why you receive a W-2 if you're employed, and a 1099 for bank interest you receive during the year from a CD or a savings account, and a 1099 for short sale debt forgiveness. This is a sample 1099-C form. This is what you'll get. And if you'll look at Block 2 and Block 3, 2 is amount of debt canceled, and 3 is interest if included in Box 2. That's because only the principal amount that was forgiven is potentially taxable. That's money you actually received and didn't pay back. Interest is money you owe, but you never received that cash, so that's not potentially taxable. Well, will I owe taxes if I receive a 1099? That's the big question. A very few people will have to pay taxes. Most of them will not. And all of us want to know, How can we be part of the most who will not have to pay taxes? How can I escape paying taxes, even though there's a 1099? There are two ways you can escape owing any taxes, even though you receive a 1099. One way is what I call the temporary crisis rule. It's recent legislation that was passed in response to the economic climate we have right now. The other way is what I call the insolvency rule. And this has been the rule for years and years and years, and this will be the rule long after this crisis is over. Here's the problem right now. The government wanted to encourage people to do short sales so there would not be so many foreclosures, but the IRS was going to claim taxes due if someone had debt forgiveness after a short sale. Most people are more afraid of the IRS than they are of their lenders and a foreclosure. So not that many short sales were taking place. That's because the right hand was working against the left hand, and the rules had to change. The change came about with what I call the temporary crisis rule. Most people watching this video will fall into this rule. It is part of the Mortgage Debt Relief Act of 2007. These rules apply until the end of 2012 for short sales and debt forgiveness that takes place from 2007 through 2012. I've seen websites and YouTube videos that say the important dates are when you borrowed the money. That's not true. The important day is when you have the debt forgiveness, not when you borrowed the money. You could have borrowed the money back in 1980. It won't make any difference. You can read more about the rules on the link below. Click through to that, or I'm going to explain them to you on this video also. Mortgage Forgiveness Debt Relief Act of 2007. This is what is necessary to qualify. The debt must be secured by your principal residence. This is a property that was your main home for 2 of the 5 years before the sale. It must be debt used to buy, build, or substantially improve your principal residence, or if it was that originally and then you refinanced, that also applies. Individuals can have up to $1 million of debt forgiveness. Married people can have up to $2 million of debt forgiveness. There will be a 1099. You will not be able to negotiate with the lender to not send a 1099. There will be one. But for most people, you will not owe any taxes. The second rule is the insolvency rule, and you are insolvent if the fair market value of your assets in today's current economic climate is less than the total of your liabilities. The insolvency rule, which is not limited to any particular years, the insolvency rule says that if you are insolvent immediately before the debt release and still insolvent immediately after the debt release, you will not owe any taxes. And let's look at an example of that. Here's before the short sale and debt relief. We have a house worth $150,000, a car worth $29,000, and miscellaneous stuff worth $5,000, for total assets of $184,000. Our liabilities consist of a mortgage of $200,000, so we are upside down on our house. A car note of $34,000, we're also upside down on our car, but that's fairly common and has been for decades. Credit card debt of $5,000 for total liabilities of $239,000. We are insolvent. We have a negative net worth of $55,000. We are underwater by $55,000. After the short sale and the debt release, we no longer have a house asset, so that asset is zero. Car is still worth $29,000. Miscellaneous stuff still worth $5,000. But now we have total assets of only $34,000. On the liability side, we no longer have any mortgage debt at all. Mortgage debt is zero. Car note is still $34,000. Credit card still $5,000. We have total liabilities of $39,000. Our net worth after the short sale and the debt forgiveness is negative $5,000. We are still underwater. We are still insolvent. So we meet the test of insolvent before and insolvent after, and we will not owe any taxes on this debt forgiveness. Well, but I told you a 1099 will be sent to the IRS. and the IRS will automatically think that you should pay taxes. So how do you head things off at the pass? What do you do so you're not just waiting for the axe to fall on an audit? Very simple answer. You file IRS Form 982 with your tax return for the year in which you had the debt relief, the year of the 1099. And I give you a link to that form, but we'll also look at a sample form on the next slide. This is Form 982. This is a simple one-page form. Part 1, Item 1 says amount excluded is due to, and then you check the box that applies. Excluded means you're telling the IRS, I know you got a 1099 on me, and let's say it says $70,000 in debt relief. Even though you got a 1099, you are not going to see that $70,000 anywhere on my tax return. I'm not listing it as income. I'm not listing it anywhere. I am excluding it for one of the following reasons. And reason A is discharge of indebtedness in a Title 11 case. That's bankruptcy, and we're not talking about bankruptcy here, so we'll skip that one. B is discharge of indebtedness to the extent insolvent. That's the insolvency test. Check that box if that's the one that applies. And then skip down to E, discharge of qualified principal residence indebtedness. That's the rule that I described that I call the crisis rule. If that's the one that applies, check that one. If you have discharge of qualified principal residence indebtedness, and, oh, by the way, you also happen to be insolvent before and after the debt relief, don't check both boxes. Just check E, because E is the one that's most correct in that situation. For more information, you can read the IRS publication, Canceled Debts, Foreclosures, Repossessions, and Abandonments. I give you 2 links to download it. Currently, the 2010 edition has a page on the IRS website, but no content there yet. They say it's coming soon. If that is still true when you try to link to it, I also give you the 2009 version of the publication. You can download that one. I don't think there will be very many differences between the 2010 and the 2009 version. And if you want still more information, you can go to the IRS's website at www.irs.gov and type your search terms in the search box at the right, and then click Search. A few disclaimers. The rules that I've described to you are much trickier if you took home office deductions. That's because part of your home was a qualified principal residence and part of it was an office. So you might have to use 2 different rules in order to not pay taxes. If you refinanced your house and took cash out to buy other stuff, put money in the bank, pay college expenses, or pay off credit card debt, for example, part of your debt will qualify for what I call the crisis rule, and part of it won't. So you might have to use the insolvency rule for the other part. And then if the property you're selling is used in your trade or business, it doesn't mean it's taxable. It just means the rules are way more complicated than I can cover in this YouTube video. Please talk to an accountant or completely read IRS Publication 4681 if you have questions. Well, I hope this answered most of the questions for you. If you found this information useful, please subscribe to this channel. I'll be posting more videos in coming weeks. Check out my website at www.deniselevans.com or sign up for my blog on WordPress at deniselevans.wordpress.com. Again, thank you for watching, and please recommend this and forward it to your friends if you think they would find it useful also.